We're live. Live from the Hard Rock Hotel. Well darn. We are live. We got some stuff to talk about. This is not exactly what I was looking for. Let me make sure my titles are correct everywhere, because that's not right. Just hasn't updated yet. Oh well. We got some. Yes, there we go. It's correct now. We got some stuff to talk about. We got lots and lots and lots of stuff to talk about. And by lots of stuff, I mean not much. Not much is happening. Let's see what's happening. Yo, Intel's up 11% on what news? What do you mean? I'm selling. Oh, they get an analyst upgrade. Amazing. 4Dimensional is up 6.5. Finally, my boys, they're coming through for me at the very end. Everything else is down. Yo, I'm finally making money on Intel. I think I'm gonna dump all my shares now. Good lord. Do I not want to own this company ever? We're good. We're good everywhere. Amazing. Yeah. Intel's up 11%. Bro. Who gave him the upgrade? Yo, look at the chart, dude. Up 20% in the last 5 days. Intel's one of the best performing stocks of the year. This is insanity. I think we're coming to the end. I think it's over. Let's see how Cisco's doing. Cisco fell a bit. Tragic. They hit their all-time high again. They posted all-time highs. Tragic. They're doing pretty well though. Everything else in my portfolio is down. CVS is flat. Well, actually, pretty much everything's flat. Berkshire's down 1%. They gave up $10 billion because Greg Abel got a 19% pay increase. He went from making $21 to $25 million a year, becoming the CEO of a $1 trillion enterprise. You really do hate to see it. Sorry. FRDM, I love this chart. It's so great. Beyond Meat's down 3%. Corsair's down 3.5%. Is there any news, or is it just being Corsair again? Corsair's DDR4 64 gigs is now $900. Tough way to go. I don't think so. Oh, let's read. Let's do some reading. Corsair Gaming recently appeared at the Barclays 23rd Annual Global Technology Conference at the Palace Hotel in San Francisco with CEO Ty Law. I don't remember this guy. And CFO Gordon Mattingly presenting the company's latest developments. Ty Law? I bet this is a woman. It is. I think I knew that. The high-profile forum gave investors a direct window into Corsair's leadership priorities around growth, product innovation, and operational exceptionalism. operational execution in gaming and creator hardware. We now consider how Corsair's conference appearance. To be a Corsair shareholder today, you need to believe in the long-term growth of PC gaming and content creation. I do. Look at me right now. Look at what I'm doing. I'm creating content. And in Corsair's ability to convert that demand into profitable, higher-margin hardware and peripherals. Maybe, maybe not. The Barclays conference appearance featuring both the CEO and newly appointed CFO mainly reinforces management's focus on execution and communication. It just okay, so basically nothing. Thank you for the nothing article. Appreciate it. Wait, what? GameStop unveils $35 billion pay plan for CEO Cohen tied to lofty targets. GameStop on Wednesday unveiled a compensation package worth roughly $35 billion for CEO Ryan Cohen, hinging on a turnaround that requires him to lift the struggling video game retailer's market value more than tenfold and sharply boost its profit. Hitting their targets will require a significant shift at GameStop, as the brick-and-mortar store operator has been losing millions in revenue in recent years, with the gamers turning to web for purchases. If we look at the history of GameStop, let's do 5 years. Yo, this chart is almost about to go away. It's down 75%. The biggest market cap GameStop ever had was $40 billion. What a thinker. The company's annual revenue has plummeted more than 35% since 2022, with stock price down 80% from all-time highs from 2021. GameStop's new pay plan laid out lofty targets for Cohen, which is now tasked with growing the company's market capitalization to $100 billion and hitting $10 billion in cumulative performance EBITDA. $10 billion in EBITDA. They have to do their market. They have to do their current market cap in EBITDA, and they have to be $100 billion market cap. I'm gonna be honest. If GameStop can get to $100 billion market cap and do $10 billion in EBITDA, Ryan Cohen deserves every bit of that $35 billion. Cohen received no guaranteed pay in the form of salary, cash bonuses, or stock options in the package, the company said. GameStop currently has a market capitalization of $9.26 billion. It hit a record of 34 at the peak of the 2021 meme stock rally. He is the company's second largest shareholder. So he owns 8% of the company. Let's do some math here. So that'd be, let's see. Yeah, that'd be 72 million. No, that'd be 720 million. So Ryan Cohen owns $720 million worth of GameStop shares. If it 10x's, he'd be worth $7.2 billion on those shares alone, and then he'd get paid an extra $35 billion, which I'm gonna be honest, that's pretty good. Sounds like a pretty good deal to me. He'd walk away with $40+ billion. I still think it's insane. Bro, listen. GameStop's market cap is $9.7 billion. They have $8 billion in cash. They have almost their market cap in cash. Now, granted, this does not mean that they're a good investment. Their revenue is falling. Their net income is up, though. Listen, it doesn't mean that you should go out and buy them. But typically, when companies have their entire market cap in cash, those companies typically tend to perform better than average. This is crazy, right? April 19th of 2024, you could have gotten GameStop for $10.42. That would have been $4.5 billion in market cap. They had $8 billion in cash. There's literally, like, that's a no-brainer at that point. And you would have been rewarded quite handsomely for that. Anyway. Yeah, GameStop, the actual, what's funny is this is going to go away here in a little bit. We're going to lose the 5-year chart. We're going to lose the short squeeze on the 5-year chart. Tragic. Anyway, the Bitcoin loss overshadowed profit turnaround. Well, GameStop doesn't seem to be the best company in the world, I think. Yo, everything's going back up. Intel has fallen 2%. Tragic. Everything is slowly marching upwards. FRDM was negative. Path, BND, and oh hey, all the bonds are up. Speaking of bonds, where are we at? Yo, we're actually still pretty cheap. We're still pretty cheap on the bonds. Bonds have gone literally nowhere in the last year. It's crazy, dude. Rates are going down, bonds are not going up. It's a scary, it's so unnerving, bro. Watching the Fed cut interest rates and bonds don't move, that's just like, that's tough. What is this? What is this? Investing in, actually, literally, since inception, you would have made only the dividends. Either way. Another big story from, I think, 2 days ago. Reports suggest that OpenAI may be looking to acquire Pinterest, which is not amazing. Not I think the best. Not good. Could OpenAI be looking to acquire Pinterest as part of its expanded data push? That's one of the rumors that gaining traction after it was highlighted in a predictions post that was published by The Information last week. According to The Information, OpenAI may be considering. I feel like I remember them talking about this. This is an old story. OpenAI, it is true. OpenAI doesn't really have a social network. I feel like the OpenAI. I feel like this stretches back to like 2024. Yeah. There's reports in like late 2024. Once Pinterest started talking about openly integrating AI into their platform, then OpenAI was like, "Hey, do we think that we might get acquired by OpenAI?" Either way, I don't think it would be a good idea. Well, not that I personally use Pinterest, but 600 million monthly active users, by the way. Every user should go out. If you want to stop the merger, every user should go out and buy a share of Pinterest right now and vote no when the merger eventually starts to happen. When OpenAI says, "Hey, we're coming out," how much is Pinterest worth? Could you imagine if they're like, "Yeah, here's 20. What are they gonna pay with?" Actually, you know what? I don't think this is gonna happen. OpenAI doesn't have any real money, and in order to acquire Pinterest, In order to acquire Pinterest, you would have to give the shareholders real money, unless you went public. Unless AI went public, OpenAI went public, in which case they could just give you shares in OpenAI. Pinterest is a $20 billion company, by the way. That seems a bit expensive. So OpenAI is not going to acquire them in cash. They would have to probably wait until they go public in order to, unless they found financing, which at this point they're already like a few $1 trillion in debt. So I don't know that they're going to find financing for it. So I doubt that this is going to happen anytime soon. But we're going to move this, that's for sure. We're going to talk about something I've been researching over the last 2 days. We're going to get into our first big story. Which is going to be insane, I think. So let's hop into it. If you don't know, Donald Trump. Oh man. Okay, there's a lot of weirdness here. I want to start off by saying something. I want to make something very clear. This is not me taking political sides. This is not a political video. I just find it interesting, right? I think that this is really interesting. Donald Trump has a controlling interest in this thing called Trump Media. Hang on. Okay, my friends are strange. Had to take a moment. Like I said, locking back in. This is not a political video. This is not me taking sides politically. This is purely investing. I find this interesting and I want to talk about it. There's a company, it's called Trump Media. It went public a couple years ago. It's under the ticker symbol. It used to be TMTG. Now the ticker symbol is DJT. When this went public, so okay, a little bit of a history lesson here. Trump Media and Technology Group was a company that was formed when the president of the United States got kicked off of all the major social media platforms for reasons. He got kicked off all the major social media platforms. And so he decided, you know what, I'm going to create my own. And so he created Trump Media and Technology Group. It went public. It has one sort of major, at the time, it had one sort of major line of business, and that was Truth Social. This is literally a social media platform on which, it's basically Twitter. A Twitter alternative. I don't think it's tremendously successful. However, successful enough. The main draw, of course, was the president at the time he was using it, and he was like, "Hey, look, it's Truth Social." Anyway, so Trump Media Technology Group. Like I said, this company went public. Went public in 2022. It merged with a SPAC called DWAC, Digital World Acquisition Corp. And it went public as Trump Media and Technology Group under the ticker symbol TMTG. It was later changed to just DJT. Why? I don't know. Anyway, it's been up, it's been down, it's been all around. And so for a long time, their only major business line was Truth Social. But they've started to expand over the last couple of years, especially in 2024 and 2025. They started to add a lot of business lines. Some of you may have seen the news recently that TMTG is merging with Tay Technologies. Tay Technologies is a fusion company. They do fusion power, basically. Tay Technologies. They do the fusion power clean energy. That's what they do. They're developing experimental ways of creating future power that's clean energy. Very cool. Why are they merging? Why is a social media company merging with a fusion energy company? I don't know, but they are. The deal is worth like $6 billion. So that's pretty cool. So now Trump Media and Technology is a fusion company along a fusion energy, a clean energy fusion company, along with owning Truth Social. Another thing that they own is a streaming service, Truth Plus, which I'm sure has some incredible shows. Not that I've ever been on it, but I'm sure they have some incredible, straight down the middle, truthful. With a name like Truth Plus, they got to be telling the truth, right? Anyway, I'm sure all their content is great. One of the lines of businesses that was announced by Trump Media and Technology Group, but no one was really exactly sure what that would look like, was their expansion into financial services. They created a subsidiary called Truth.fi, and this was the sort of main vehicle that would tackle financial services for Trump Media and Technology Group. So back in January 29th of 2025, so almost exactly a year ago, Trump Media Technology Group, operator of the social media platform Truth Social and the video streaming platform Truth Plus, announced that they were invest $250 million into SMAs and ETFs. At the time, there wasn't really... This was just, kind of a flying under the radar announcement. Nobody was really talking about this. But it turns out that we finally got the fruits. So Trump Financial, obviously, or Truth Financial, hasn't exactly had an actual business. They've just kind of been building in the background, and nobody's really been sort of following this. Neither have I. I didn't even really know what was going on. And so in the last couple of days, we have seen the efforts of this expansion into financial services. Trump Media Technology Group has just launched 5 Made in America ETFs, testing whether political power is an investable theme. This is an article from Morningstar. Truth Social ETFs have unique holdings, but it's unclear how much Trump's policies will influence their performance. These are thematic ETFs. So over the last couple of years, we have seen a lot of ETFs get brought to market for all sorts of different reasons. And a lot of these new age ETFs sort of have themes to them. And so if there's something specific that you want to invest in, and you think that there's some broader sort of movement that is going to happen and you think that you can profit from it, that's what a lot of these thematic ETFs were based off of. And so, of course, like I said, there are 5 ETFs, and we're gonna look at them, and we're just gonna do some investigation. We're gonna look into them. We're gonna find out what's going on here. Truth Social's ETFs launched today. There are 5. There's the Truth Social American Security and Defense ETF. So hey, look, good ETF. Truth Social American Next Frontiers ETF. This is probably, of all of them, the most interesting ETF. There's the American Icons ETF, which is an ETF that tracks sort of iconic American companies. We'll get into the holdings of all these a little bit later. There's the American Energy Security ETF, which is an interesting ETF, let me tell you. And then quite possibly the most enigmatic of all of the ETFs, the Truth Social American Red State REITs ETF. This is just a fascinating ETF that it holds REITs, so real estate investment trusts, that are headquartered and operate primarily in American red states, or states that have voted for Republicans in two of the last three elections, which is fascinating. Trump Media CEO and Chairman Devin Nunes says, Trump Media CEO and Chairman Devin Nunes says, we're gratified to make available a slate of ETFs for patriotic investors who want to invest in American ingenuity. These unique funds provide an excellent way for Americans to express their optimism about the strength, resiliency, and immense future prospects of the American economy. And so, of course, me being me, I decided to do just a little bit of reading in this is the prospectus. So every time an ETF goes public, the company that launches the ETF has to provide what's called a prospectus. And so this is something for investors to just learn about the fund, to learn sort of what the goals are, to get the expense ratios, to understand basically what they're investing in. And so I'm going to look at one. We're only going to look at one because basically a lot of these are copy-pasted. So, your investment objectives, fees, and expenses, we'll get into all that a little bit later. But there's sort of two important things I want to pull out from here. Fund summary, Truth Social American Red State REITs ETF. And I'm going to choose this one because there's something else that's because I can sort of explain what's going on with this. Everything else is sort of self-explanatory except for this one. So, obviously, the investment objective is the Truth Social American Red State REITs ETF, and is to seek to provide investment results before fees and expenses corresponding generally to the price and yield performance of the market vector iREIT Real Estate REITs Index. So this is our first really interesting bit of information. These are not actively managed funds. Now, thematic funds, especially the ones that have gone public over the last couple of years, a lot of them are what's called actively managed funds. And these are funds where there is a portfolio manager who is actively making decisions about the holdings in the companies. This fund purports to be a passive fund. And so what that means is that you have the fund and it tracks an index. And so it doesn't make individual, and so the fund, the controllers of the fund do not make individual investing decisions. Instead, it just tracks a pre-specified index. This is becoming incredibly common over the last couple of years. You have a fund that is set up that creates an index, and then you have an ETF that follows that index and is therefore passive. When you can actively manage the actual index itself. And of course, remember, an index is just a list of stocks that follow a specific theme. So, for instance, the S&P 500 Index Fund, SPY. So, SPY. This is an index fund. It's just a list of stocks, and the list is the 500 largest companies in the United States by market cap. So, of course, you have NVIDIA at the top, and then, Tesla, Google, Apple, Amazon, all the companies. And it's listed from top to bottom by market cap weight. And so an index is literally just a list of companies that has a specific criteria. It's that simple. And so we'll get into what that specific criteria is, but this is very important. So all of these funds purport to be passive index funds that, we just invest in the index, but the index is actively managed. So fees and expenses. This is something I'm going to talk about in depth a little bit later, but all of the management fees for all of these is 0.65%, which for a passive index is incredibly high. but we'll get into that in a little bit. So for example, $10,000 invested over 1 year, you pay $66 to own this fund. Over 3 years, that's $208 every 3 years in order to just hold the fund. Portfolio turnover. There's no portfolio turnover information available. Obviously, these funds launched last week. Okay, the fund seeks to replicate the iREIT Red State REITs Index. The fund employs a full replication strategy, which just means that we want to fully replicate the underlying index. So let's talk about the index. Information about the market vector iREIT Red State REITs Index. It is designed to track the performance of real estate investment trusts that earn the majority of their revenues or income from U.S. states that voted for Republican presidential candidates in 2 of the last 3 elections. To be eligible for inclusion in the underlying index, securities must be organized as REITs and have revenue or income attribution thresholds from state-level political outcomes. To qualify for initial inclusion, a company must have at least 65% of its revenues or net operating income from or 65% of its properties in states that voted for or carried a Republican presidential candidate in 2 of the last 3 presidential elections. Existing constituents may remain in the underlying index with at least 50% of their revenues. So you can. Okay, so basically, this is the most interesting of all of the ETFs in terms of like actual strategy. Everything else is quite simple. Everything else is quite straightforward. This is an overtly political ETF. This is overt in its investing strategy. It is literally going out and saying, we think that real estate investment trusts that operate in Republican states or states that vote for Republicans will perform better. Out of all of the ETFs, this is the most novel strategy. If you think that's true, have at it. I don't think that there are many ETFs like this. There are a couple. But there's no ETF that is as direct as this, as literally, we are only going to invest in companies that operate in Republican-led states. And we think that the real estate companies in those states will outperform. And that's, you know what? You may disagree politically, but that's fair enough. But strategy. If it works, it works. At the end of the day, the only thing that matters is returns. The only thing that matters in investing, at least, is returns. So, and so that's, of course, the most unique of all of these ETFs. Now, another thing that I want to point out is the 1792 exchange. Every single one of these ETFs has an additional criteria by which they measure all of the underlying stocks. And this is called the 1792 Exchange. It is a nonprofit organization that publishes information regarding corporate policies and practices that it characterizes as relating to corporate bias risk. Its analysis is based on 6 publicly disclosed criteria, including whether a company, we'll get into that in just a second. And so basically, the 1792 Exchange goes out and evaluates all these different companies, all these different publicly traded companies. You can think of this almost like ESG. So if you're not familiar with ESG, it's environmental, social, and governance. Basically, there was a trend a couple of years ago where investors were like, hey, we think that in general, companies should be environmentally conscious. They should be increasingly aware of their social impact, and we think that they should have good governance. And so there were a couple of firms that came out and started to actually track companies based off of how well they fit these criteria. And so ESG was sort of like a big thing. It became a very big thematic event to invest in, right? You could buy companies, that had really high ESG scores, and those companies typically turned out pretty well. And so this is basically the same thing. The 1792 exchange is basically coming out and saying, hey, we have a list of 6 criteria that we think that if a company follows these 6 criteria, and we're gonna score companies based off of these 6 criteria, and these 6 criteria are gonna determine whether we think that this is a good investment or not. And so it's very reminiscent of ESG, a very almost like conservative take on ESG. And so what that is the underlying index does not use the 1792 exchange overall risk ratings in determining the underlying index. Obviously, they can't. They're passively managed funds. They have to follow the index. And so these are DEI quotas, whether the issuer incorporates hiring or human resources quotas tied to diversity, equity, and inclusion initiatives. CEI participation, this is the Corporate Equality Index, as measured by the Human Rights Campaign. Abortion travel benefits, funding of non-business causes, cancellation, which is an incredible metric to try and determine whether or not. Imagine just trying to measure if a company is like canceling their employees. But anyway, I digress. And then transgender coverage. If you notice, these are very hard to define things. DEI quotas is kind of like a nothing thing. CEI participation, I think that's most companies at this point. Abortion travel benefits, okay, fine, fair enough. Funding of non-business causes, who's determining what a non-business cause is? Is a non-business cause political donations? Because that's a very non-business cause. And so if you're determining like your funding of non-business causes, if that's like political donations, at that point you've disqualified every publicly traded company on the planet, not only in the United States but in the entire world. Cancellation, I can't even imagine how they begin to track that stat. And transgender coverage, that might be a little bit more publicly available, but either way. So the underlying index, when the people that are determining what actually goes into the index, and we'll get into who's determining what goes into the index in a second. So it's a company called Yorkville Advisors. So Yorkville Advisors is the one that actually creates and maintains these indexes. These are the people that are actively managing these indexes for these passive funds. And so when Yorkville Advisors are creating these indexes and managing them, they use the 1792 exchange, and they will exclude companies that do not meet a specific amount of criteria for the. Let me see if I can find this exactly. Yeah, the methodology treats the company as having no disqualifying okay. Yeah, so the underlying indexes exclude companies that violate 5 of the 6 activities described. Good Lord. The underlying index excludes companies that violate 5 of the 6 activities described above. So, if any company violates 5 of these, let's say these 5, they will be completely excluded from the index. 100% gone. If the 1792 exchange has not collected information on a specific criterion for a company, the methodology treats the company as having no disqualifying information on that specific criterion. So I would imagine that for a lot of companies, they probably don't make a lot of this stuff publicly available. And if they do, they get kicked out. And if they do and they have it, they get kicked out. But basically, this is sort of like an added layer on top of what's going into these indexes. So not only do you have sort of like the investment objective of the underlying index, which obviously, as you can see, for this REIT in particular, the iREIT Red State REITs Index, you have to have 65% of your business in a Republican state, but also your business has to not violate 5 of these 6 very specific criteria. And so it's an interesting approach for sure. I don't think it's a particular. It's a thematic ETF with an ESG element. At the end of the day, Which, like, yeah, fair enough, I guess. But, and so now we're gonna look at who's actually running these, who's actually creating these indexes, and that is Yorkville Advisors. Yorkville Advisors is a company. Let me tell you. Yorkville Advisors traces its origins back to 2001. They've done $7.5 billion in transaction. Wow. Not a ton is known about this company. A little bit is known. They're based in New Jersey. They've been around since 2001. They have about $300 million in assets under management, and they're very good friends of the TMTG people. New Jersey-based Yorkville Advisors affiliate tapped as the registered investment advisor for Trump Media's financial venture. So this was, of course, last year. We were talking about this a little while ago. So January 31st, 2025, is when Yorkville Advisors, a Mountainside, New Jersey-based investment manager, will guide Trump Media's new financial services venture in decisions regarding its America First investment strategies. So this is the company that actually goes out and they create the ETFs that the TMTG, what are they called? What is this called? Truth Social Funds, yes. So these are the guys that actually create the indexes. So they're going to go out, they're going to partner with 1792. They're going to partner, they're actually partnering with the 1792 exchange in order to build these indexes. And so these are also the people that probably sort of came up with the idea for these indexes. Like, hey, here's our sort of America First ETFs. And so one of I think an important note, in 2018, technically in 2012, but all the way up until 2018, Yorkville was under investigation by the SEC from 2012 to 2018, because they allegedly, the regulator, the SEC was investigating them because they alleged that the practice had led to pension funds and funds selling the firm more than $280 million in investments, which allowed Yorkville to charge them $10 million in fees. They were alleging that the CEO and CFO had intentionally overvalued the assets under management and exaggerated returns to hide losses and boost fee collection. It is worth noting, however, that a federal judge in 2018 dismissed this case, saying that there was no material evidence of fraud or negligence. But it is important to note that this company was under investigation for 6 years by the SEC for basically lying to their investors, the vast majority of which are pension funds, which is not ideal, I think. But anyway, so these are the guys that are actually maintaining, they built the ETFs, or they built the indexes on which the ETFs rely, and they maintain them. Now, not a ton is known. Also, kind of strange, Yorkville's $300 million in assets under management is not a lot for a firm that's been around since 2001, right? 25 years. They've been around for 25 years now. They have $300 million in assets under management, and they get tapped. Kind of an interesting choice. Either way, one of the sort of important things I want to talk about, going back to this, is something I glanced over a little bit ago, was the fees and expenses of the fund. The total fund operating expenses is 0.65%. This does not seem like a lot, right? 0.65% is less than 1%. It's a little over half of a percentage point. It doesn't seem like a lot, but in the world of investing, in the world of passive index funds, it is a gigantic amount. And I'll explain why. First of all, Schwab, the industry asset weighted average, or for the industry asset weighted average for passively managed ETFs is about 0.15% in terms of management fees. So the average company is pulling in the industry asset weighted average for not actively. The industry asset weighted average for passively managed ETFs is about 0.15%. And so for these ETFs to quadruple that is makes them expensive categorically in the world of passively managed ETFs. Because again, the whole idea of a passively managed ETF is that you're not paying your advisors, right? You don't need to pay advisors because they're not actively trading the fund, right? There's no active decisions being made. It's all 100% passive. They're just tracking an index. And so for this to be so expensive, for the management fees across the board to be quadruple the national average is cause for concern, I believe. And the other thing is, once you get to the really big ETFs, like 0.15 looks expensive. Now the difference between 0.03, which is sort of, quickly becoming the industry average, especially for like the ultra passive funds like Vanguard and BlackRock, the management fees are like 0.03%. For most, the industry average is, of course, 0.15%, so quite a bit lower. But again, it may not seem like a lot, but it's important to note that these differences add up, because at the end of the day, the main thing that makes investing work, is time. It's the amount of time that you allow money to grow. So this is actually a really good article, Trade That Swing, where they sort of talk about management fees and how it can absolutely destroy a portfolio over very long periods of time. And so there's just one very specific part that I want to highlight here. So 0.3% difference in expense ratio. So this is the difference between a 0.15% passively managed ETF and a 0.65% managed ETF. Actually, the difference between that is 0.5. And so this is even smaller. So this is 0.3. So assume one fund charges 0.04% and another charges 0.01%. If we deposited $100,000 and let it grow for 30 years at 7.6%, which is 8% less than 0.04% fee, we'll have $900,260 at retirement. In the lower fund fee, the yearly return is 7.9%, and we end up with $978. Let me actually pull this way further. I want to just highlight one quick thing from this article, which I think is really important, and this is a 0.3% difference in expense ratio. So the difference between the industry average of 0.15 and the TMTG average of 0.65 is obviously 0.5. And so this is just talking about a 0.3% difference. This is the impact of how just 0.3% of management fees can affect your portfolio over a very long period of time. Assume one fund charges 0.04% and another charges 0.1%. If we deposited $100,000 and let it grow for 30 years, which, reasonable, we will have $900,260 at the end at retirement at a 7.6% growth rate, which is 8%, the industry average, less a 0.4% fee. In the lower fee fund, the yearly return is 7.9%. So literally 7.6% versus 7.9%. And the lower fee fund ends up with $978,685. With the higher fee ETF, we've lost $78,000 for nothing. More than that, more than what most people make in a year. Put another way, we lost $2,600 per year, or about $200 per month over the time frame. And that's just a 0.3% difference. Imagine what like a 0.5% difference looks like. Actually, let's do the math on that. I want to do the math on that right now. This is a basic compound interest. This is a basic compound interest calculator. You can find this on the government's website. This is very good. I've trusted this for a very long time. Let's take their $100,000 figure. We're not going to contribute anything monthly. We're going to wait 30 years. Estimated interest rate. We'll do 7.97%. Actually, let's do 7.9%. And we'll calculate it. So, like we said, we have $978,685.92 of retirement. Exactly what the article said. So now, let's turn this into, instead of 8%, it's going to be 7.35 instead of 8%. So this is going from a 0.1% fee to a 0.65% fee. That turns into $839,578. That's crazy. The difference is, it's $140,000 difference over 30 years. $140,000. If you go with a 7.9% interest, let's actually make this as close as possible. 7.85% to get the industry average. So 7.85% is $965,000 over 30 years. If you cut it down to 7.35%, which is the expense ratio for these, it's $840,000, losing over $100,000 to just fees, and that's where your money is going, is you're paying the fees because you're losing performance, and that's I think one of the biggest dangers of these ETFs. Now we're going to get into the actual specific investments of these ETFs and why I think that they might just be bad funds overall. But it's important to remember, this expense ratio, 0.65%, is far too high, especially for passively managed ETFs. So let's get into the ETFs themselves. I've taken the liberty of investigating all of these ETFs and have found lower cost alternatives to all of them that provide basically the same performance. And I think actually we'll probably outperform these ETFs over the next couple of years. Investing in American exceptionalism. So let's take a look. Our very first ETF is TSRS, the Truth Social American Red State REIT ETF, one that we've been talking about for quite some time. Its biggest holdings, Vici, Broadstone, NNN, Realty, and Four Corners. The ETF that I chose to displace this one is SCHH. This is the Charles Schwab U.S. REIT ETF. This is another passively managed ETF that tracks the Dow Jones Equity All REIT Capped Index. So this is just a better run ETF that tracks a better index. The expense ratio on this, where'd it go? I just saw it. The net expense ratio is 0.07%. So this is about 10%. You're paying about 10% of the fees. They charge 90% less. This is a 90% off ETF that you can buy. They own Welltower, Prologis, Equinix, Simon Property, American Tower. Some of the best real estate companies in the United States, and you can own them. And these are all United States companies that operate primarily in the United States. And so, of course, this would be the main difference. You're not going to find exactly so. And so, I want to just start with this one because this is the kind of like weirdest ETF. This one has a very specific political bend. It says that, hey, if you invest in real estate companies in red states, you're going to outperform. And so there's no other ETF really like it on the market, and so it's very hard to compare to. But I think Schwab does an incredible job with SCHH. They have the Dow Jones Equity All REIT Capped Index, which is a primarily United States-based real estate investment trust index. And so I think that this is probably the closest that you can get, and you pay significantly less to own it. Moving on, we have TSES, which is the TSES, the Truth Social American Energy Security ETF. This is an ETF that invests basically in oil and gas companies, which has performed very well over the last couple of days. If you've been following the news, you would know why. Its largest holding is Chevron, ExxonMobil, Eaton, ConocoPhillips, Southern, Duke, NextEra, Constellation Energy, and GE Vernova. Interestingly, most of these are the sort of fully integrated pipeline distributors. So you have upstream, downstream, and midstream. Apart from Williams is sort of midstream, and Duke Energy I think is upstream. But mostly you have this sort of fully integrated oil and gas providers. For this ETF, I have found the Vanguard Energy ETF. This is another incredible. This is a great index. Its expense ratio is 0.09%, so about a fifth of the fees of Donald Trump Media and Technology Group's ETFs, and it tracks a much better index. And this is also more concentrated. Again, and so a lot of this is also integrated. So your biggest holdings look very similar. So ExxonMobil, Chevron, ConocoPhillips, Williams, Kinder Morgan. I love Kinder Morgan. Anyway, so your holdings look very similar. So this is an ETF. Now, obviously, your top holdings like ExxonMobil and Chevron are a lot more concentrated. But this is a good example of. This is basically the exact same ETF, except you're paying a fifth of the fees, right? And so why would you go out and invest in something like this, TSES? Why would you go out and invest in something like this, American Energy Security, which is basically the exact same ETF as the Vanguard Energy ETF? You're paying less in fees and you're getting basically the same performance. And let's be honest, Vanguard is probably a better investment advisor than, a random $300 million AUM investment advisor based in New Jersey. Welcome back. So like I was saying, I don't know why we would trust an investment advisor that, forgive me, but has $300 million in assets under management, and it's been around for 25 years, sure, but I don't know why we wouldn't just go with the gigantic company that has proven that they are able to at least outperform their own benchmarks with their ETFs. And that's sort of the broader point. Not only are you getting better performance, but you're getting better performance at lower fees. And while I totally understand the idea of we should sort of invest in the things that we believe in, I don't know why you would just sacrifice performance. If you think that energy is sort of a big trend over the next couple of years, and it's hard to beat this ETF. It's hard to beat ExxonMobil and Chevron. Let's be honest, making up 36% of the index. Moving on, we have an interesting ETF for sure. The Truth Social American Security and Defense ETF. This is a defense ETF. Very simple. It owns RTX, Palantir, Palo Alto, Lockheed, CrowdStrike, General Dynamics. One of the sort of interesting things. One of the sort of interesting things that I found investigating these sort of ETFs is they have their main central theme. But they also have other weird companies. They also have other weird companies that they like to include. So for a defense company, CrowdStrike is an interesting addition. I get it, cybersecurity, 100%. But if your thing is security and it's just American security and defense ETF, it's a very non-traditional security and defense ETF. Because if you have, the ETF, which I'm going to talk about in a second, typically you have government contractors. And of course, you have big government contractors, RTX, Palantir, Lockheed, but you get a sort of interesting dynamic with at least some of these ETFs, where you have the sort of basic companies that all of these ETFs basically invest in. But you also have some interesting additions. Axon is an interesting addition. Let me tell you, to a security ETF, fascinating stuff. Axon makes cameras, basically. They make camera systems. Specifically, their largest consumer, I think, is the police. Fortinet, another one of these cybersecurity stocks. Very interesting. Just interesting stuff. And so, again, also it's very hard to find an alternative to this, but I think I found a good one. XAR is the aerospace and defense ETF. This holds a lot more this is the sort of traditional defense ETF that people would buy. Its gross expense ratio is pretty high too, 0.35%. Still, almost half of TMTG's expense ratio. And so, like I said, you get some interesting companies in here too, though. Rocket Lab, Karman, and AeroVironment, very interesting companies. Kratos, Defense and Security, Boeing. These companies are all sort of on the cutting edge of aerospace and defense. But then you also have sort of your Huntington Ingalls, which is the big shipbuilder, Heiko, Woodward. Your sort of mainstay staples of the defense industry, and also like Boeing. But you also get the incredibly cutting edge names, which I think is sort of what this ETF is trying to do, right? Especially with your Palantir, your CrowdStrike, and your Fortinet. You're trying to get this sort of base of good, strong companies, RTX, Lockheed, but you're trying to include some interesting cutting edge companies like Fortinet, obviously. And I think XAR is doing sort of the same thing. They have a lot of holdings. A lot of them are in the sort of rock solid, strong companies that you would expect. Your Lockheed's, Huntington Ingalls, but you also have the cutting edge stuff. And so this is what I would do. If I'm going to pay high management fees, this is something that I would expect to get. But yeah, if I'm going to go up and pay high management fees, this is the type of thing that I would expect to get for those management fees. Rocket Lab, Carmen, an interesting set. If I'm going to go all the way up to 0.65, I better be getting the greatest ETF ever. And so to have XAR be doing what TSSD is basically doing, except they're doing it better, is not great. It is not looking good. The goat is washed, unfortunately. It would seem. But yeah, finally, what is this? Next up, we have what I think is the most interesting ETF, right? We had the Red State Real Estate Index Fund. Sure, fine. But this one, I spent the most amount of time looking for an ETF to replicate this. This is an utterly fascinating ETF. This fund, actually, I want to download the full holdings for this. I'm so curious. Hopefully that this doesn't... Yeah, it's an XLS. That sucks. Can I get the... Hang on. What is this? This is TSNF. I need to know the full holdings of this company. It holds 133 companies. So this is the most diversified company which is a fascinating portfolio, that's for sure. Yes. Okay, here we go. Morningstar coming through clutch. We have TSNF. This is the Truth Social American Next Frontiers ETF. This is the most diversified ETF in the entire list. And it is diversified across technology mostly, and then healthcare and industrials. This is fascinating stuff. Planet Labs, right? Planet Labs is a satellite company. Intuitive Machines, a satellite company. Marvel Technology, I believe, is also a satellite company. And then you have KLA, which makes specialized KLA makes specialized machinery for the semiconductor industry. You have Rocket Lab, which is a satellite company. You have Figure Technology, which I think is a satellite technology. You have HUD 8 Mining Corp, which is that Bitcoin mining company turned into AI data center infrastructure company. You have Northrop Grumman, which is a government contractor that makes missiles. You have AeroVironment, which is another satellite company that does that's a government contractor. Same thing with Firefly Aerospace. You have Lam Research. What does Lam Research do? I think semiconductors. Okay, I should know that. You have Lam Research, which is semiconductors. D-Wave Quantum, which is quantum computing. Innodata. Teradyne, another satellite company. Micron, more semiconductors. Xometry, which I think is semiconductors. Block is such an interesting company to have in this ETF. MongoDB, you're just getting the most. This is a crazy ETF. They're just like, the board meeting that was held to invest in these specific companies must have been absolutely fascinating. But yeah, so that's basically, TSNF. This is the next frontiers, what we think is the innovative companies. And so basically what this fund boils down to is they own satellite companies and semiconductor companies. And so I found Rocket, the State Street, Spider, S&P, Kensho, Final Frontiers ETF. Again, another fairly high gross expense ratio, 0.45, still considerably less than 0.65. And we saw that even a 0.3% difference, it means possibly up to $80,000 over the investing life of the ETF. And so in this, we have a lot of the same companies, right? We have Planet Labs, Intuitive, Rocket, Redwire, Boeing, Heiko. And so what's interesting about this is you have the incredibly innovative companies sort of at the top, and then you have a base of very strong, sort of baseline innovation at the bottom. And so of all of the ETFs, if you're going to invest in any of these TMTG ETFs, I would say TSNF would probably be the most interesting in terms of outright investment strategy, because this is just the most random collection of companies that you can get. This reminds me of like an ARKK, right? Like the ARK Innovation Index, where they're just like, we've gone out and we think that these companies are going to outperform other companies over the next couple of years, which is a fine investing strategy. I don't think it's going to work out all that well. And so like ARKK is kind of like its own thing at this point. It's got its own lane. It doesn't really have any competitors. That doesn't make it good, however. The investing strategy is still up for debate. However, you can get a lot of the same companies that are owned in TSNF. You can get them elsewhere for lower fees and better strategy, I think. And that leaves us with the Truth Social American Icons ETF. I love this ETF. It's a great ETF. It owns American icons. Top 10 holdings include Netflix, Home Depot, Walmart, Costco, Pepsi, McDonald's, Uber, Procter & Gamble, Lowe's, and Altria. This is a bet fundamentally on the future of America. This is a bet on the fundamentally on the future of America. These companies primarily operate in the United States, of course, except for Pepsi. But these are the biggest companies. They're not woke, folks. They're not woke, and that's why they're in the ETF. They're not woke, which is fantastic. And so this is literally just an S&P 500 index fund that has an ESG. Actually, funnily enough, this is literally just an ESG S&P 500 index fund. So they took the S&P 500 index fund and then they added their own like unique kind of ESG, which is the 1792 exchange, and they said, "Hey, all the companies in this index, we're going to take out all the ones that we think are like woke or whatever, or don't fit these very specific, let's say conservative criteria." And we're just going to, market cap weight them, and we're going to call them American icons, right? And so, you have your American icons. And so, for this ETF, what I've chosen is another bet on America. This is EGLE. This is the Global X. This is the S&P 500 U.S. Revenue Leaders ETF. The fundamental investing goal of this is putting the United States as the core building blocks of this ETF and the structure of it, or the holdings of it. The S&P 500 U.S. Revenue Leaders Index screens S&P 500 companies for a minimum of 50% revenue generated within the United States, identifying stocks that may benefit from long-term U.S. economic strength. So if you want to bet on the U.S., EGLE is your ETF. And so, at the top, you have Microsoft, Amazon, Palantir, Berkshire, JP Morgan, Micron, Eli Lilly, Oracle, Cisco, and Salesforce, companies that derive at least 50% of their revenue from the United States and would therefore benefit from a much stronger United States. And of course, these are all, you all sort of have the same companies. You got Costco in there, Walmart. They're just a little further down in terms of holdings. But also 10%, Microsoft is crazy. And then the management fee, of course. The management fee is 0.2. So you're paying about a third. You're paying about a third of the management fees of TMTG. I have been at this for quite some time, which is kind of funny. And so basically, I think that you can get every single one of these ETFs. I think you can get every single one of these ETFs. I think you can find better versions for lower expense. You can find better versions with lower expense ratios. Good Lord. You can find cheaper versions. You can find better versions of every single one of these ETFs for lower expense ratios. And I think I've demonstrated that quite accurately here. But yeah, if you want to invest in American exceptionalism, you can do so without paying a very hefty price. Again, this is not a political video. I don't care what the political stance is here. I don't necessarily have a political stance here. What I care about is good investing, and this is not good investing. If you're going to go out and you're going to buy ETFs, even if you want to invest in the Patriot economy like this, there are other places that you can do it and you won't get fleeced for management fees. I feel like this is such a big trend over the last couple of years where every single even vaguely or remotely financially connected entity is trying to throw up some ETFs in order to pull in management fees. I talked about this a little while ago. The Motley Fool did this. The Motley Fool is they're sort of the Motley Fool does, stock market news and investing research. They pushed out a bunch of ETFs a couple of years ago, all with fairly high expense ratios, 0.5%, not incredibly high, but 0.5% is 0.5%. And all of these are basically ETFs that you can get everywhere else in the market. You can get better versions for lower management fees. So your passive ETFs, active ETFs, you have a small cap growth, mid cap, you have a global opportunities, you have the 100 index, you have the next index, you have the capital efficiency index, which genuinely the capital efficiency index, maybe there's something to be said here. But again, this is a passive ETF with an expense ratio of 0.5%. If you go to the active ETFs, your expense ratio jumps to 0.85%, which is crazy. For you have an innovation ETF. Oh, great. Yeah, you can get in line with the other 50 companies that have innovation ETFs. And so I think broadly, it's very, you need to not get suckered into this, because these companies are very opportunistic, obviously. They're like, hey, we have a large base of people that follow us, that respect us for our financial takes. And even, you can say that, TMTG obviously has a following, and he has people that are willing to invest in these companies, that are willing to invest in these ETFs, but he's just doing it to fleece them for management fees, because you can find all these other ETFs elsewhere for lower cost. And so I want to go back. I want to see, is there a total assets under management? Oh. Net assets is 250,000. $2.3 million. 2.3 million. 260,000. 250,000. And so this is sort of what I'm saying, right? So obviously these are incredibly new ETFs. They just launched literally a couple of days ago. I think they were listed on January 3rd. Today's January 7th, so 4 days ago. But like your net assets, 250,000, 2.3 million in the energy ETF, of course, 2.3 million in the security ETF, 260,000 in the Next Frontiers ETF, and then 250,000 in the American Icons ETF. It's not a ton of money that are invested in these, but like they're pulling a lot of expenses. They're fleecing their investors for expense ratios. Shares outstanding is 10,000. But yeah, it's. I just think it's bad management, and you shouldn't get suckered into this. This is something that I've been complaining about for a very long time. The average ETF, the average fund manager, the average index will just underperform the S&P 500. There are so few indexes that are able to beat just the 500 largest companies in the United States, right? You can't beat them. It's just too good. The S&P 500 is the benchmark for a reason. And so if you read the perspectives of every single one of these funds is going to say, "Oh, well, we're beating our benchmark." What's our benchmark? Some random fund or index or whatever. But fundamentally they're not going to be able to do it. You're going to underperform the S&P 500. Now, granted, there might be periods where some of these ETFs are able to outperform others, or able to outperform the S&P 500, right? We saw this, actually, one of the things that I wanted to bring up was ARK itself. I made mention of this, but now I want to sort of tie it all back to ARK. ARK Invest was a very popular ETF a couple of years ago. Basically, they launched ARKK, which was an ETF that had incredibly high expense ratios, but they said, hey, we're going to go out and we're going to invest in the future. We're going to invest in innovation. And we are going to beat the market, basically. And so it was obviously headed by Cathie Wood. And it had great performance, right? That's the thing. ARK Invest had incredible performance for about 2.5 years, where it absolutely annihilated the S&P 500. There was a period of time where if you were following ARK, you got to about here-ish, where the total return over the last 5 years, the S&P 500 returned 134%. Meanwhile, ARK returned 1,000% from July 2016 to 2021, right? Incredible performance. But then, as time goes on, ARK started to perform less and less good, and it started to fall dramatically. Now, if you got out, you made a ton of money, congratulations. But remember, this right here was peak popularity. Everybody was investing in ARK because genuinely, the ARK had almost 10x the performance of the S&P 500 over the last 5 years. They were destroying the index, but then it continued to fall, and then eventually it's underperforming the S&P 500. And of course, over the last 5 years, it has dramatically underperformed the S&P 500. With the S&P 500 returning 98% and ARK returning negative 35% over the last 5 years. And so, of course, you can have periods of outperformance. If you go to the last year, if you go to the last 3 years, again, ARK is on a rebound, right? It's having this incredible performance. But you cannot look at this over these periods of time. It's great if you invested here, but very likely you probably invested all the way back here, and you're probably still down on your money. Significantly down on your money, right? If you'd invested here, I actually invested in ARK. I bought, I think in the low 70s and sold in the high 80s. I probably invested somewhere around here, sold somewhere around here. I invested, but very likely I would have turned into one of the investors that would still be down on his money. And so I think it's very important to not get caught up in performance. So let's say I am wrong. And let's say I am wrong and these ETFs do perform well for the first couple of years, which I would imagine that at least some of these might. So the Next Frontiers, a lot of that is your sort of semiconductor stuff. And these ETFs might perform pretty well. It's important to remember that very likely they will not beat the S&P 500, and on top of that, you're getting fleeced for management fees, basically, which is not ideal, and should be avoided if at all possible. But this is just an old man ranting at clouds, I believe. So if you don't believe me, go out and invest in them. I'm sure over the next couple of years, I'll be very interested to see, especially on some of the interesting ones, like the Next Frontiers and the real estate. The Red State Real Estate ETF must be the most interesting ETF in the world, I think. It's just gotta be. The Red State Real Estate ETF is one I want to follow because, like, it's at least saying something, right? It's so sad when you see just like another company come up and we're like, oh, we're doing ETFs. Oh, what kind of ETFs? Oh, the same ETFs that literally everybody else is doing. It's like, well, say something with your ETFs. If you're gonna come out and you're gonna put out an investing product, at least make it different. And you're gonna charge incredibly exorbitant management fees, at least make it different. At least make it interesting. At least say like, you know what? We're only gonna invest in, what's something that I would do. I don't even know. We're only gonna invest in, like, the Red State Real Estate ETF. It's like we're only going to invest in real estate companies that invest in red states. It's like, it's at least interesting. But, like, don't give me another American Icons ETF. I can just go buy a equal weighted or US tech leaders or US revenue leaders ETF. Don't give me another security and defense ETF. I have like 400 of those, right? And they perform better. Say something with your ETFs. Don't give me this junk about like, oh, here's the exact same ETF that literally everybody else has launched. We just have higher management fees. It's like, come on. Anyway, rant over. And actually video over. So like I said, upon further investigation, I do not believe that these are necessarily the best ETFs. I do not believe that these are necessarily the best ETFs. I would advise not investing in them. Not because they are inherently bad, but because you can find better performing ETFs with longer histories and lower management fees literally everywhere else. Apart from maybe one or two of them, if you genuinely believe in the premise, right? If you think that, like, not American Icons, if you think that like the Next Frontiers ETF genuinely has some interesting companies that nobody else is able to capture in their ETFs, then like go for it. The largest holding in their portfolio is cash, which is very funny. But if you think like these companies are going to be the ones that outperform over the next couple of years, hey, listen, go for it. This is a pretty diversified portfolio though, right? 114 holdings is kind of a lot. They do have a lot of holdings, and so they are well diversified. And so you might lose some of the innovation aspects with that diversity. But yeah, if you think that, hey, who am I to judge? I think ultimately, if you're going to invest in passive ETFs, you should just go for an S&P 500 and maybe like a TLT, like a bond ETF. I don't think that you should be going out and buying ETFs like this, especially not ones like this, just because they're just not good. I don't think that there's anything necessarily inherently wrong with these ETFs. The problem is, of course, they're just like every other ETF. They just have higher management fees. And so I think they should be avoided. I don't think investors should invest in them. And so with that, if you enjoyed this video, I hope that you learned something and you don't hate me too much. If you like this style, please like, subscribe, and come hang out live. We love talking about this stuff live. Good Lord. I do need to go and I need to edit these videos, unfortunately. I really did want to get this video recorded today, and I think I did a pretty good job. I think I hit all the notes that I wanted to, for the most part. And that's all that's fundamentally all I really wanted to talk about. And so I think we're gonna go. Yeah, I think we're gonna go edit some videos. Thanks everyone so much for hanging out. I'll be back probably on Monday with a stream, talking about all sorts of stuff, I'm sure. Let's see if there's anything going on before I head out. That's terrifying. $1,000 a month monthly payments, crazy. Warner Brothers rejects latest Paramount bid. Backs Netflix again. They made another bid? Did they up the bid? Nope. How's Intel doing? Intel's still up 8%. A crazy time, I think. Kathy Wood's ARK Invest takes best performing issue of 2025. Wow. I took a bad time to talk about ARK in a negative light. Tragic. Anyway. Yeah, it's gonna be ain't much else going on. S&P 500 is up 0.24% though. Thanks for hanging out. Kobe.